Okay, well, good afternoon to everybody, and welcome to the latest event in our online speaker series, Financial Commentary for Smart People. Bill Blain will shortly make a bold attempt to demystify us all with his take on what's really going on in the world's financial markets and why perhaps this time round it really is different, or not, as the case may be. In our speaker series, we of course aim to bring together SIOR members and guests with high-level speakers for topical and educational discussions. And therefore, thank you for joining us from around continental Europe, from Ireland and from the UK. As most of you know, I'm Paul Danks, I'm president of the SIOR European chapter, and I'm director of corporate solutions at Devono Cressa. As you can see, we've set this event as a Zoom call meeting, not as a webinar. So at the end of the presentation, you'll have an opportunity to ask Bill questions live and to contribute to the discussion. However, please note that you are all currently on mute. And if you do have a question, then as I say, at the end of Bill's presentation, please raise your virtual hand and we will come back to you. And before we start, I'd like to offer special thanks to TSL, our first industry partner, and to the SIOR Foundation, joint sponsors of today's event with Bill. Now, a little background on Bill. Bill is a published author on financial markets, contributor and indeed editor and founder of Blain's Morning Porridge. He is a well-known market commentator and a practicing investment banker in the alternative private debt and equity sectors. In his day job, Bill works for SIOR Capital, the leading investment management firm, where he combines the role as strategist and heading the firm's alternatives group. That group finances private debt and equity deals and direct lending transactions. Bill's clients include sovereign wealth funds, hedge funds, insurance companies and pension managers, credit funds, and family offices. Bill's 36-year career in global markets is unique. It includes senior level roles as head of financial institutions and debt capital markets at leading investment firms, plus spells as a financial market journalist, despite being dyslexic and utterly unable to spell. Firms on Bill's CV include Morgan Stanley, Bear Stearns, HSBC, and BGC. Bill has been closely involved in the growth and development of the global fixed income markets since 1985, and he pioneered complex financial products, including corporate bonds, bank capital, medium-term loans, asset-backed securities, and private debt and equity. There's a box full of industry awards for things like the most innovative ABS transaction, Capital Deal of the Year, and Top MTN Firm, and many, many more. Bill is also a respected author, and his most recent book, The Fifth Horseman, a polemic on how to destroy the global economy and other matters, is available on Amazon, and I'm reading it myself, and it really is a must read. Outside of markets, as you probably heard earlier, Bill is a passionate sailor and ocean racer. He says he's a talentless painter and a bad guitar player, but true to his heritage, he is still learning to play the bagpipes, and he once built a train set in his attic. He's also a trustee of Wessex Heartbeat, a charity that supports victims and their families of cardiac disease. SIOR Europe will be making a donation to Wessex Heartbeat in lieu of Bill's speaker fee, and I encourage you all to visit their website and consider making a donation yourself, of course mentioning Bill in the comment when you make the donation. And now I'd like to hand over to Bill, and you're going to find this really entertaining. Bill, here you go.
Wow. What a lot of pressure to put on me. Yeah, the last time I saw Paul, I should say, my yacht was moored up in Salcombe, and this little figure appeared in his canoe. I did invite him on board for gin and tonics, but he declined. I think he was more worried about tumbling out of the canoe as he tried to clamber on board the yacht.
That's true.
Anyway, I'm really delighted to have time to come and speak today. As Paul said, I do a morning commentary called The Morning Porridge, and you can find it on www.morningporridge.com. And every day, before I start my day job in the alternative asset markets, I try and put down what are the things I think are going to move markets the most. And today I thought, since you guys are all largely in the property markets, I could talk about the distortions that are driving markets just now, why we see such extraordinary pricing in the markets, and where that is going to lead us in terms of pricing in areas such as the alternative market, which includes property. So let me just start off by talking about distortion. When I talk about market distortion, what I'm going to refer to here is the fact that today's markets seem to be perfectly anticipating a perfect future. We've got stock markets at absolute record levels. We've got bond yields extraordinarily low, although every time bond yields start to go up, people start to panic. And we have a general sense that the world is about to emerge from the pandemic and everything's going to get better. Markets are anticipating a perfect future, but we all know when we look at the markets that they are anything but perfect. We've never seen so many apparent crazy pricing examples, whether it's Tesla, which is worth umpteen times more than car companies that produce equally good cars at much higher margins and in much greater numbers, or whether it's special purpose acquisition companies that are taking barely profitable and often unprofitable tech companies public for enormous multiples. There are just too many examples. Bitcoin would be another. Why is it people are jumping onto the Bitcoin wagon? Well, I want to try and explain that in terms of why it's happening. And it all boils down to a very simple distortion. And that distortion is all related to what we've seen since the global financial crisis began in 2007. And note that I say the global financial crisis that began, because it's my contention that what started in 2007 is really a long-term process, and we're nowhere near the end of it yet. And one of the key things that we saw were a number of policy mistakes that occurred around about the time of the global financial crisis after Lehman Brothers went bust, which of course was the trigger for the real panic, collapse in markets, everyone anticipating every single bank was going to disappear, and therefore any asset-backed security was worth diddly squat. That's not, of course, what happened, because central banks very quickly stepped in. They very quickly provided support for the market. And one of the critical things they did was to maneuver interest rates lower. Now, since then, the dominant theme since 2008 has been monetary experimentation, where we've seen central banks drag interest rates lower and lower. And they've achieved that through monetary control, through quantitative easing. By buying bonds, their own bonds in the market, they push interest rates lower. But of course, as financiers, we all know that the critical interest rate is what we call the risk-free rate, which in the UK is the gilt rate, the UK government bond. And if you push that yield down, every other asset trades relative to that asset. So if you push bond yields low, then any other asset that yields more looks relatively more attractive. And that's been one of the real factors that has driven the growth in stock markets since 2009, when the recovery started. If bond yields are too low and people need to generate returns for their funds, then you're going to see other assets start to go up. And it's not just stock markets where we've seen that happen. Every other asset trades relative to the risk-free rate. So if you think you can generate returns from other alternative assets, non-financial assets, and by financial assets, I mean stocks and bonds, then you might see things like property start to go up because the returns look more attractive than the underlying risk-free bond rate. Or one of the other markets where I've been very heavily involved in aircraft, we've seen the same thing happening to comparatively recently. You've got this distortion goes on, and that creates consequences, and consequences have other consequences. It becomes a rolling cascade of consequences that goes through markets. And one of the key ones that we all need to think about is, what does it do to pensions? So you find that many of the big pension investors in the country, they suddenly find themselves facing lower and lower bond yields. If they buy bonds, they're not going to be able to pay their liabilities to pensioners. So they had to think about, how do I increase my yield? Now they can look at the market and they can say, if I buy stocks, that's too risky, because a 6% yield on a dividend yield in a stock may be far more risky than a 3% yield on a bond in terms of that relative trade-off. But they decide that something else makes sense. And that's when you get opportunistic shysters jumping into the market. And of course, I'm sure all of you are very aware of Greensill. Greensill, the Lex Greensill, the Australian financier who came in and promised everyone that he could generate very substantial returns based on a very old financial engineering trick called forfeiting, where basically you are willing to pay upfront invoices before they're actually paid by the customer. And that is a very long established and very low risk and therefore very low yielding financial instrument. But Lex Greensill was able to convince people that he had created a magic around that, and it appealed to fund managers who were desperate to achieve returns. And I'm sure you've read in the papers that the firm that fell for it most was a company called GAM, a big Swiss institution. And they had a very successful fund that invested in fixed income markets. It made a decent index beating return. But the fund manager saw these instruments and thought, oh, they look much more yieldy. Oh, and he promises that they're more liquid and they will less risky. Therefore, it ended up nearly 2/3 of that fund was invested in these funds. And then someone started to ask questions about why all these instruments seem to be tied up to a very dodgy looking steel maker, where the credit metrics looked very poor. How could they possibly be AAA assets when they were linked to Gupta that looked a BBB company? And as a result, there was an internal investigation. It was discovered that there had been a lack of due diligence on these particular instruments, and they had to gradually get rid of them. The fund manager got sacked. As a result, there was a series of redemptions on the fund, and GAM has lost significant value. Its place as one of the leading investors in London has evaporated. But why did the fund manager do that? Because he was faced with exactly the same problem everyone else faces. How do you generate returns in a period where the risk-free rate is so low that it makes every other risk rate look relatively more attractive? And as soon as you put ideas in front of people that this is a less risky and higher returning asset, they'll tend to jump all over it. Now, I would put it to you that the reason that we are seeing such mega high valuations across all the global stock markets is the same thing going on. People are willing to speculate because the risk-free rate is so low. When bond yields, which we assume are not going to default, and that the UK gilt never will default, when they're so low, then you've got to look at other things. And that's what drives this crazy speculation that seems to underlie markets today. Now, over one of the other major things that happened at the time of the global financial crisis beginning was the regulators saw what had happened, massive over leverage, where banks had lent far more than they had capital to cover. And the result was that new regulations were put in place to reduce the amount of leverage in the system, therefore making the markets less liquid, because of a bank can only certain assets for its trading, because the capital cost that's tradable in the market, and less appetite from the banks to go ahead and be willing to make markets by buying and selling financial assets like stocks and shares. But the central banks then came up with the idea that I mentioned earlier of quantitative easing, where they were willing to step in and buy debt, initially only government debt, but now corporate debt as well. So you have this picture of liquidity that central banks are ultimately acting as the buyers of last resort. And that again has caused people to go out and assume that the markets are more liquid than they actually are. So we've got two factors going on now. We have a vastly overpriced market because people don't understand the relationship to the underlying risk-free rate. And then we have a market massively overconfident about liquidity. And then last week, we had this new financial scandal to arbitrage the rules because nobody regulates family offices. And it looks like they had something like $30 billion of financial instrument leveraged in the market playing on a couple of stocks. And when the 5 banks that were providing prime brokerage services to Archegos, as the fund was called, suddenly realized they were all backing the same assets, you then saw this desperate scramble by the banks to exit their positions. First went Morgan Stanley, very quickly followed by Goldman, and it's always Goldman Sachs at the center of these things. And the result was poor old Credit Suisse, Credit Suisse as they're now called, they were the ones who got stuffed, and they've just announced a massive loss as a result of the over leverage that they had provided to this fund. Now, the question, of course, that's running through everyone's head is how many other funds are in the same position? How many other funds have been over leveraging themselves to invest stocks the last few years? And very quickly after the collapse of Lehman, people realized that as soon as central banks come in to regulate markets, funds will start to arbitrage these rules. And that's exactly what we've seen with Archegos. But other things also go on as well. It's not just the over leveraging or the lack of understanding about liquidity or the failure to really price risk properly. There are other factors going on, and that's the way that when we originally planned quantitative easing, the assumption was going to be that if government central banks bought back government bonds, that the funds selling these government bonds would then invest that money in the real economy. And that money would flow into the real economy and create jobs, creating wealth, but also likely to create inflation. But of course, the inflation never appeared. We've had almost zero inflation here in Europe. If you look at the way that the ECB has been buying back bonds later to the party than everyone else, it has completely and utterly failed to generate any inflation. And we haven't seen all that cash reinvested in the market. And the reason for that is that financial investment managers are very smart and very clever about what they invest in. When interest rates are so low, why they take the risk investing in the real economy? It's much better simply to continue it in financial assets. If you know central banks are continuing to buy government bonds, then use that money so you can sell them, make a profit, and you get that money and you buy more, and the price continues to go on. And that's exactly what we've seen since 2009. Government bond yields falling, which means the price goes up, and all the investors who've been playing the QE game following bond prices lower. And that is why we've seen such a wobble in markets in the last couple of weeks, because of the threat that bond yields might be starting to tick back up again. You may remember a few years ago, we had something called the taper tantrum, when the Americans decided they were no longer going to be supporting interest rates in the way that they were, and were going to start normalizing. And the immediate response was a massive crash in stock markets. So what we've seen is a very close relationship between the price of stocks and the price of bonds. The two of them are mutually feeding off each other, and that's what's been driving the market. Now, we call listed stocks and listed bonds financial assets. It's a very simple description of anything that trades on a fairly regular basis. And it became very clear to me in the early 2010s that the distortions that were driving stock prices and bond prices were going to continue. But if you're an investor, you still want to be finding proper yields. And it became clear to me the place to be investing was not in financial assets. And I've been a bond trader all my life since 1985. But you wanted to look at buying real assets. And this is where it gets really interesting, because real assets are real things producing real returns. And you can structure them in very many different ways to meet the needs of the market. And of course, property is one of the key ways of doing that. Back in my early career, when I joined Bear Stearns in the early 1990s, one of the first things I got involved in was the residential mortgage-backed securities market. Now, you'll all remember it was ABS, asset-backed securities, and mortgage-backed bonds, and prime, subprime lenders that caused the crash in 2007. Yep, I was behind all these things. I was one of the people, I was in New York trading them, and then came back to London and was very involved in originating them and trading them. And they are generally a very good asset, because you're looking at people who are buying property and are financing that property with mortgages. And for them to retain that property, they have to be paying the mortgage off. And that's what creates the coupon, the dividend payment on the security. And it generally worked very, very well, because people will know that most people will continue to make their mortgage payments. At least that's the assumption that's always made. But one of the key things you learn about markets is never assume anything will happen the way you think it will. People describe the collapse, the events that led to the collapse of Lehman, as a once in a 5,000-year event, a 33 sigma or something like that, they call it. But of course, what we see in markets is these things happen repeatedly. And this is where we come to the next point that I really wanted to make about markets. People make a really serious fundamental error when they're thinking about markets, when they think that markets are based on logic and smarts and understanding the fundamentals. People think that if you do all the analysis in a company and really understand every single aspect of its accounting, every single aspect of its supply chain, why its management are doing such a good or bad job, and does it meet all the sustainability, corporate social responsibility, and all the other ESG CAC that people talk about, then that's going to make it a superb company. But that's not the way it works in markets at all. Markets are actually just an enormous voting machine. It's not what you know, it's what the market believes that sets the price. And as a voting machine, the market collects what everyone thinks. So I can sit there and I can write in my morning porridge every day about this price for Tesla makes no sense at all. It's absolutely crazy that a company that hasn't made a single penny selling cars, because it hasn't, but has only ever made its minuscule profits based on selling regulatory credits, because that's a fact, How is it that that company is valued so much more than all the other companies in the auto sector? Well, you can say it's because it's started a revolution, an electric vehicle revolution, and I will then point out that there are now 150 new electric vehicle companies launched in the last 5 years, many of which are securing funding. And if I look at their business plans, every single one of these 150 companies expects to sell 5 million vehicles by 2025, when global demand for electric vehicles will be somewhere between 25 and 30 million vehicles a year. And at the same time, we have Audi and Volkswagen and every other serious, well-managed, proper car maker launching their own range of electric vehicles, which day by day will get better. And I could cite you the story of how a Porsche, what they call is a Taycan, the Porsche electric vehicle. One of them recently won the Cannonball Run, which you, of course, will all remember is that race from the East Coast to the West Coast of the States. And they now do it in electric cars. And the current record holder, 2 days or something, is a Porsche Taycan, not a Tesla. Tesla's response to that is, for an extra $120,000, you can buy the top of the range Tesla with extra batteries that will beat that time. So far, nobody's taken up the offer to buy it. I know all these things about Tesla because I spend too much time looking at Tesla. I know it's a bad investment from any fundamental way. But you know what? I've got Tesla in my stock. It's in my portfolio. Not many, because I have been easing down on the position. But the reason I hold it is because it doesn't matter what I believe. It matters what the market believes. And if the market is foolish enough to believe in Tesla, then who am I to deny it? So you've got to try and follow these trends. But there are real assets that do have fundamental value and strength. And there's a couple of really interesting ones there. One of the key things that people talk about in the market all the time today is ESG, environmental, social, and governance investing. In fact, most new funds will immediately try and claim to be compliant with ESG. And recently I had a very interesting deal in the alternative space, and it was, you might have seen it in the news, West Cumbria Mining. We were the financiers behind that deal. I had arranged to finance it with a hedge fund that was very involved in global commodities and mining. They managed to get past all the ESG issues. They thought the company was superbly well managed. They thought their social program was excellent, creating jobs in a real job black spot on the Cumbrian coast, and also an ex-mining town. And they also saw that the demand for the product would be extremely strong. And on the environmental front, by importing metallurgical coal from Australia and steel from China, we create billions of tons of carbon emissions. We could cut all these by using local coal. And they saw that there was a railway in place that would make that very easy to do. You'd export it by rail to Redcar, sorry, you'd transfer it by rail to Redcar, and then it would be exported from Redcar port either to Europe, where there was demand, or to Wales, where, funnily enough, the Gupta's steel mills would use this stuff. And that way, we'd be able to supply 450 tons of steel out in the North Sea. So that would have been a win-win for everyone from an environmental perspective. Now, the deal has collapsed because the government has turned around and said, oh, we don't want Alok Sharma being chairman of COP26 in Glasgow come October if we've just allowed the opening of a coal mine. It would make the UK look terrible. Well, you know what? The UK just looks stupid as a result, because we've increased our carbon emissions and we're denying 300 good jobs in a place that needed them, and we're not using our natural materials. All we've done is export the carbon pollution we might have created somewhere else, and that is Australia and China. That's an example of how modern thinking on a deal goes wrong. But if I'm looking to try and create returns, and I want solid risk-free returns, I want to get the credit risk as close as possible to that risk-free rate I talked about. Now, soon after the global financial crisis in 2008, when it began, or 2007 when it began, I realized the property sector was terribly interesting, because at that point, if you were a property developer, you went straight to your bank. You went to usually our boss, and our boss would provide you whatever you needed to go ahead and do your development. That all very quickly dried up following the crisis because banks became very unwilling to lend. And very quickly we realized that you don't need banks to lend. If you take a look at the UK in 2007, if you were wanting to finance any kind of development or building project or new infrastructure project or a new factory, whatever, you would go to your bank to do it. 80% of funding in Europe was provided directly by banks. But if you went to the States, that number was completely reversed. Banks only provided 20% of funding. The rest of it all came direct from institutional money. So in 2010, I set up a small bank, or was involved in the setup of a small bank, where our focus would be on providing finance for sectors that were suddenly finding themselves blocked because of the lack of bank lending. And we called it the alternative sector. Now, I think property is going to be one of the most interesting areas, again, in that area. Now, we're all aware that everyone today wants logistics. They want to get centers so they can let Amazon deliver anywhere in the country. But reading the news this morning, I thought it was fascinating that there was AXA announcing the launch of a 1 billion fund to invest in UK office real estate. They clearly see that the way the market has performed in the last 15 months, where there has been an absolute discount applied to any form of office space on the basis that there is going to be a massive sell-off because nobody wants to go back to the office because we're all also happy working from home, that as a result, office prices will crash and you'll end up with empty offices. Not so. And I think I agree with AXA, because the reality is that most of us are bored shitless staying at home the whole time. I find I work harder working at home. It's not much fun working at home when all it is the office has taken over my home. I'd quite like to go back to the office at some point, although I will caveat that by saying I live down in Hamble on the south coast. That's where I keep my boats. And that means getting a train up to Waterloo from Southampton. And it is now the worst train line in Europe officially. So if I go up 2 or 3 days a week, that will suit me fine. Even better, not working from home is working from boat, as I did last year, traveling around the south coast of England using the computer on the boat. And you know what? It worked just fine. Anyway, these are just a few of my thoughts about why markets are so distorted. Bear in mind that it's the interest rate being so low that creates the consequences of distortions. And one of these distortions is the way that people become more attracted to speculative investments. And bear in mind that when interest rates are so low and they're driving rapid price gains in stocks, that tends to fuel speculation. We call it FOMO, fear of missing out. Everyone's scared not to have stocks in their portfolio, so they've all been buying, and that's one of the reasons they continue to go up. How much longer will we go on? Well, we just don't know. At the moment, interest rates are remaining low, so the party keeps going. But at some stage, we will face a crisis. And I'm wondering if that stage is getting closer, because there has been a massive shift just in the last few months. And that shift is that after 2008, the policy response from governments after bailing out the banks was to enact austerity in order to keep debt borrowing levels low. Well, austerity didn't work. It didn't help the economy recover, and certainly debt levels continued to go up. In just the last year, we have seen the amount of money in circulation around the world grow by about a quarter. There is more money in circulation today than there's ever been before, but we still have very little inflation. Now, I think inflation is going to start biting into the real economy, and it's going to happen fairly soon. And why? Well, simply because what we've seen since 2008 has been inflation, but it's all been within financial assets. It's been within stocks and bonds. It hasn't got into the real economy because all the money flows were circular within markets. Now, as governments start to spend on promoting recovery and infrastructure projects, you're going to see that money getting into the real economy. And I got a really good example of what's going to happen occurring yesterday. I'm currently up in Edinburgh, staying in my mother's house. I'm officially acting as her carer this week, although she's doing very well. She's actually bossing my wife around just now in the other room because her tea probably won't be milky enough, or it's the wrong biscuit, something like that. But yesterday I took a walk, and just down the hill from here is a fantastic garden centre. Well, the garden centre is only opened 2 days ago in Scotland, and I have never seen their enormous car park so busy. So I wandered in to have a look, and the queues were right round the shop. People were buying everything and anything. The amount of repressed spending that is about to occur within the economy is going to be huge. And you'll see that sentiment echoed by the things Jamie Dimon, the CEO of JP Morgan, was talking about yesterday when he said he predicts a massive recovery right the way into 2023. I think it's going to happen, but that's when you see inflation. Now, markets hate inflation for obvious reasons. It destroys the value of your current assets against your future liabilities. But it's also something that governments will quite like to see, because governments, of course, are now very highly indebted. And the great advantage of inflation is it works down your debt much faster than trying to repay it. So I think we're going to see an element of inflation in the real world. Now, what does that mean for real assets? Well, again, I think that's a massive positive for property, because you can talk about gold, or idiots talk about Bitcoin as the ultimate inflation hedge. But if I take a look at the history of UK housing, for instance, it's been the best hedge against inflation ever. Anyway, these are just a ramble through some of the things. I'm usually much funnier when I write it in the morning. So if you get a chance to read the Morning Porridge, there's usually more humor than that, than I've given you in this little ramble. I wonder if that's enough, and I should stop and let you all start to bombard me with questions.
Bill, I think, I mean, we could go on for hours, I know. And I do encourage everybody to subscribe to Blain's Morning Porridge. It really is something to, I was going to say, brighten up your day every morning. It generally puts a smile on my face when I read it. So please do subscribe to it. So well done with that, Bill. I'll start off.
Okay, you start off, Paul. Michael Payne has a question as well. He's put his hand up.
Okay, I'll just start off with a couple of questions, and it relates to some adages, Bill, and I know you like adages. So you can only control what you can control, and also he or she who shouts loudest. And we seem to be in this bizarre world where we've got regulatory authorities all over the place, and yet we've still got Credit Suisses and Greensills, etc., etc. So, in a nutshell, why is actually going on? Why aren't the real professionals shouting, "This is nonsense! All this regulation is doing nothing for us"? What's going on in your view?
Okay, I think Credit Suisse is a great example of why risk management is daft. All the big financial institutions today employ legions of risk managers and compliance officers. And at the end of the day, they're just a cost. As soon as you start to regulate something, the markets will seek to arbitrage it. And as soon as you start to measure something, you'll be buried in information. And from what I can garner from my friends within Credit Suisse, Lisa Warner, who was the senior risk manager, her position has been under threat for a long time after a series of repeated mistakes. Greensil's the biggest one, and now this Archegos one. But there was so much information that you start to get buried by it. it becomes very difficult to function. It's also very difficult to understand if you're a risk manager rather than a risk taker. So institutions that have effective risk management are the ones where the risk takers and the risk managers are together. Now, I think it's very interesting when you look at the approach of Goldman Sachs. Goldman Sachs initially refused to deal with the guy behind Archegos, Bill Blain. They said he'd already been done for insider trading. They didn't like the look of the unregulated family office, but they saw that everyone else was trading with him. So they got together, and with their eyes wide open, they started dealing with Archegos. And we reckon it was Goldman Sachs who were the first to realize what was going on, that Archegos was basically playing everyone else against each other. Compare and contrast that to the way where the very bureaucratic functions of risk management, which siloed risk takers from risk managers, occurred within Credit Suisse. And it's no wonder that, I mean, I'm actually really surprised that Deutsche Bank, who were involved in this, they actually managed to get out without a loss. Normally, Deutsche Bank, who are an intensely bureaucratic institution, would have failed as well. But you don't need to keep this just Credit Suisse. If you look at any UK bank, now I spent 5 years with HSBC, and let me make clear, I love the people at HSBC. They're wonderful people, but it was the biggest mistake I made in my career because it was such an intensely bureaucratic and disorganized institution. Loads and loads of managers who could not manage their way out from behind a wet Sunday post. I think it's a big danger in banking that it becomes too bureaucratic. And so it's like any investment you make. What's the first thing you should do? Look in the eyes of the management and wonder if these guys can run it. And you look in the eyes of some of the Glacier idiots. Oh, I'm getting all my Scottish voice back now. I'm back in Edinburgh.
And so much gets swept under the carpet. But Michael, you had a question. Yeah, you're on mute, so you'll have to unmute yourself.
Thank you, Paul, and thank you very much, Bill, for a really interesting chat. I have to say, I'm really interesting. Based on your commentary, it would seem to me that we are in a classic asset price bubble driven, as you were saying earlier, by low interest rates.
Yeah.
And as sure as night follows day, as you say, inflation will take off, interest rates will go up, and hey ho, there'll be a correction in asset prices. But if that scenario were to play out, my question is, what have the central banks got left in their armory to correct and amend the international global economy, because they seem to be running out of weapons to correct these problems? Okay.
That is a very, very good question. The key thing is that central banks can still manipulate that core interest rate. So they'll continue to pile in print money through QE to keep interest rates low in the hope that that maintains the asset bubble. Because the last thing that central banks want to see is a market crash undoing the positive sentiment that they hope is going to drive recovery. But I think there's two other forces at work just now. I mean, whatever you hear me say about central bankers, they are not daft and they're not stupid. They're very, very clever people and they get this. And I am sure they are as desperate to find a way out as possible. So I think we may see a series of managed events that will allow markets to absorb rising inflation and be able to take some limited degree of pain. I know that if the market collapsed today and the stock market goes down 20%, that tomorrow morning, as interest rates tumble, they will go back up 15%, because that's the kind of magnitude of change we're seeing. Everyone just waiting for the buy opportunity. I'm no different than that, because I know that's the way the market is going to behave. It doesn't make much sense. I know that they're massively overvalued, but I'll still have to follow and play it. What we fundamentally need to see, though, is a reassessment of what the real value in these things are. And that is going to be very difficult to achieve. And frankly, I don't know how they're going to do it. There's all kinds of discussion about a debt jubilee or, or whatever, but all these things are extremely difficult to work. And then you've got the bigger issue of what are the other influences that will drive this. We haven't talked at all about politics, which I consider to be extremely important in setting the market tone, and geopolitics, which is the issue of what's going to happen between the West and China. I mean, I don't think it's as clear set as folk think it is. I think China has enormous problems of its own, but they're just coping with them better. Oh, that's because they don't have the kind of political dissent. Now, one of the best things that could happen to the USA would be for Biden to get his infrastructure program put in place. But the thing is, it won't happen because nobody's going to support it. We've got on one side AOC and the extreme left of the Democrats saying it's not enough. And it wouldn't matter if Biden was to propose a Donald Trump package, it would still be voted down by the Republicans. So it's that kind of gridlock, and the prospect of gridlock not solving anything leads me to conclude that asset bubbles exist, and they're going to continue to exist because central banks don't have any alternative but to let them do so.
Okay.
Thank you.
Thank you for that, Paul. Paul McDowell. Paul is sitting in Dublin, Bill. An Ireland, as we know, following the crash, has certainly had its ups and downs. Paul, what's your take on some of the things that Bill has had to say?
Well, first of all, Bill, I have to say that was very interesting, and I love following those sort of thought processes on these asset bubbles, and I think I completely agree with you. I would be quite interested to hear you just develop a little bit your comments there as to why property is provided the best hedge. Maybe just, I'd like to hear your thoughts on that a little bit more, perhaps. Okay,
let's start off with housing. We are housing in the UK. If you look back on the records, housing will have periodic collapses, but every collapse within 18 months to 24 months will recover back to where it was and will rise again, very much in line with the economy. In fact, if you look at, there are definitely places where housing is hot, London being the obvious one, but we're now seeing it all around the country, that housing prices are going up. Now, if it follows its normal course, housing will continue to rise because governments will never be able to legislate for enough supply, and we will see it continue to beat inflation. It's not a perfect hedge, but it's one we'd expect. At the same time, the value of property within London, everyone's saying London's going to crash because demand for office property in the city will disappear. I think that's a massive over-exaggeration because people always make the assumption things are going to be the very worst case scenario. It's actually, I haven't talked about my market mantras, but there are 23 Blain's market mantras. And one of them is things are never as good as you hope they're going to be, but neither are they as bad as you fear. The key one is markets only have one objective, and that is to inflict the maximum amount of pain on the maximum number of participants. But do bear in mind that one about things never being as bad. And so if you look at the history of office property in London and housing, it would certainly lead me to conclude that housing, bricks and mortar, is a pretty good hedge. Now, we did think, and we made very strong arguments that there were other alternative asset classes that could only ever go up. And this is where it gets interesting about aviation, because everyone had been busily piling into aviation through the 2010s. People saw that global demand for travel was going up and up and up, and that we needed 10,000 new aircraft in the next 10 years. And we were only getting 500 new ones each year. So therefore the price of the underlying aircraft assets could only go up. And it was very, very predictable what the price of these assets would be because you knew pretty much what a 10-year-old, a 15-year-old, a 20-year-old, even a 30-year-old Boeing 777 would be, or 737. And then, of course, we got this unexpected, knockout event. And many of the asset classes in aviation that we perceived really good future value in now have effectively zero value. And that's just an illustration of how far that collapse can go. But we know that property, bricks and mortar, will always have some value. You're always going to be able to do something with office space, even though it may be expensive. But I reckon that as we see Europe and the UK diverge, you will very quickly see new entrants coming into the market in London who want office space. And we've got an interesting story of our own. We have a floor, we have 120 people in Shard. We have an office on the Walkie Talkie building. We also have offices in the West End. And we were wondering, what are we going to do with all this space if many of us want to work from home more? And we've actually been approached from the bank down below us. They want more space. So we may have been able to work out part of our lease. That's confidential for this meeting. I mean, I think since you're sitting in Ireland though, Paul, it's probably worth talking about or suggesting that you read very carefully Janet Yellen's recent comments about US taxation, because dare I say it, I think that has implications for Ireland.
I think we all understand that, and obviously Ireland will continue to resist it. But I think underlying we all understand that. And whilst, yeah, obviously, low corporation tax is helpful in attracting investment, it's not the only thing. The one thing I would say, by the way, and I'm not sure where I got this statistic from, so please don't quote me, but if you take Ireland's corporation tax at 12.5%, and you equate it with French corporation tax, comparing like with like, in other words, our 12.5% is absolutely transparent with very little deductions allowed. The French corporation tax based on Irish rules is actually only 17%.
Right.
So that you've just got to be sure,
That's interesting. I saw Charlie perk up when you started that one.
Yeah.
Let's move over to France. Let's get some commentary from France. Charles, you'll have to unmute yourself.
Indeed, what an old horse trader he is. I mean, we love him. It's only 5 basis points difference on Google's turnover. That's quite a lot of money, Paul. So I don't see why you should have that and we shouldn't have some hospitals. But that's all. Bill, if I can ask you a question. Sure. You mentioned that magic P word, pensions, which is affecting a number of people on this screen, apart from the guy with the neat cravat in the middle, I can see. Hello, Matt. But I was just wondering, in your opinion, if returns are going to be so low, is the pensions machine, as we've known it, completely broken? And is all that money that I've paid into Barclays over the years actually going to shrink away as they say, sorry, we promised you that, but projections can go down as well as up?
No, that again, Charlie, that's a great question, because, and I think this is another example of the sort of bureaucratic mindthink that afflicts the whole financial centre. When I were a young man back in the 1980s and it was all buccaneering, can-do spirit, we went off and we did stuff and we took risk and we had fun. That doesn't happen now in investment firms. Investment firms are not run by investment managers. They are run by middling managers in compliance, in human resources, in operational risk management. And they read books about, because books are much better than experience. We all know that, said he sarcastically. So they read books saying that the mix should be 60-40 bond to equity. And then they get all kind of bullshit with the fund managers who don't follow that because they're off to make returns. And then they turn around, and this again must not go beyond this call, but the very first pension fund that I called up about our West Cumbria mining deal was the obvious one. Can anyone guess who it was? It was the Coal Board pension. You know, they have 35 billion under management for 350,000 former coal miners in the UK. And it struck me as an absolute no-brainer that they would finance this deal. I could not believe it when they came back to me and said, oh, we've just had a meeting and apparently it breaches our ESG guidelines. Well, I quickly ascertained that Scargill's son is on the investment board, so I let him know that. he was unamused. But it's that kind of groupthink that is the real issue. If you're an imaginative fund manager, there's no reason why you cannot go out and achieve good returns, but you need to work at them. And that means getting away from correlated bubblicious markets and stocks and looking at alternatives, including things like property as part of, my recommendation to any fund manager is if they're just buying bonds, they are absolutely rubber ducked. If they are buying a mix of bonds and stocks, they're going to have to be very careful. But if they're decorrelating their risks by investing in alternative real assets, they're going to do much better. Now, these real assets are not without risk. They are certainly less liquid. They're more difficult to get in and out of, but they'll certainly produce, if you do them right and you do the due diligence on them properly, much more sustainable and predictable returns. And as we all know, the ultimate game in investment management is to produce dull, boring, predictable, but pension-beating returns. And on the question of pensions, I manage my own. I run my own portfolio. Part of it's in a SIP and part of it's just in various other private banks and things.
Okay, let's get a bit of perspective from Germany. Uli and Torsten, you're still on the call, yeah? You'll have to unmute. Uli? Torsten?
I got problems with my connection.
I'll ask the question as they don't. Right, Uli's come on board. Uli,
Yeah.
Germany's going obviously in for an interesting year with Merkel on her way and everything else that's going on there. What's your sort of your view on life and any questions that come to you from what Bill's posed to us in terms of his thoughts?
Not easy to answer because we are living at the moment in a world of change, and it was interesting that he told us that Tesla is not the big enemy and that he hopes so, seeing that the German automotive industry will recover. I hope so, because my daughter is working for Daimler-Benz, and we are looking at that incredible Tesla story each and every day. The main problem I think we will have this year is first the pandemic and second our election. You're absolutely right. Merkel will go after 16 years. My personal view is that it's time that she's going. And the problem at the moment is that the Greens are to be seen to be in the lead in September. And that will cause a lot of problems, especially for our profession, because they want to have more environmental legal issues to clarify, and we have to do many things which will what will increase the cost for buildings, and that's one issue. Then they want to perhaps do a coalition with the socialists and perhaps the liberals, what might be possible at the moment according to the polls. But that means that taxes will go up, and taxes as well for property and for people who are owning property. And so that is all not very good for the market at the moment, because nobody knows in which direction we will go during the next 4 years. So very, very interesting times at the moment. And I fully agree with Bill Blain that he's saying I'm not foreseeing big problems for the existing buildings, but what we see at the moment is that investments are going a little bit back, and because the people, even if we have low yields, but the building and construction costs are going up extremely, and the other issues on matters like environmental, like taxes and so on, are disturbing the market. So I'm a bit pessimistic at the moment.
Yeah, I think
Bill, to pick up on that and add to what Uli says, I mean the German government, if you like, or the banks have been very good at my comment about controlling the situation, not necessarily writing down value of assets when they should have wrote down values of assets and so on. And so we know, and it doesn't just apply to Germany, we know in many countries there's lots of things that are not out there in the open, which we all know have actually been going on behind the scenes. So how do you see Germany in particular over the next year, over the next few years, as it moves into this different phase?
I think the big risk for Germany isn't really Germany itself. I've watched Germany for many, many years as a young banker. Despite the fact my German was terrible, I got covering the German beat. And I actually loved it. It was great fun covering Landesbanks and many of the German financial institutions. Really enjoyed it. I don't think the problem is going to be Germany. It'll sort itself out. I think the problem is going to be more European. And I'm not some kind of vicious Brexiteer. I think that the strains and stresses that we've seen exhibited through the botched vaccine handling is going to create further tension within Europe, but especially nations that desperately need to reflate their economies. And now the only way they can do it is by begging it from the ECB or the new European Union controlled rescue funds. That's going to create all kinds of issues because as the German Constitutional Court is asking just now, they are not going to countenance Germany being on the hook for the rest of Europe. And that, I think, is going to create tensions. Now, I'm not for a second advocating a breakup in Europe or a breakup in the euro, but I just think the distractions of an incompetent Brussels compared to the rest of Europe is a danger. But I also agree with Yuli that the outlook for German politics, and I did say that politics is vitally important, it just looks terribly botched because a year ago, there was a very careful succession planning for Germany in place. I was not worried about Germany. I was worried about who was going to replace Macron in France because that's a much more difficult one to call. All Macron needed to do was do enough that he would win a plebiscite against Le Pen of the National Front. Because everyone would vote against the National Front, meaning he would win. What's now happening in France is it looks like people are now saying, you know what, Macron's so bad, we will vote at National Front. But in Germany, the risk is, and don't take my word for it because I'm not there, it does look tremendously fractured between state and federal level. And the bickering that you're seeing going on within the party is incredible. And it's opening up this window that the Greens will jump in and exploit. Now, at the moment, I'm sitting in Scotland, which is a good example of a one-party state that is marching down every wrong road that it can find. I just hope that Germany doesn't do the same thing.
That is what we all hope, yeah. Yeah, but you know, I think I agree. Brussels is a real problem, especially at the moment. It's absolutely chaotic, and the discussion what will happen to all the loans in the EC.
Okay, can we? We're sort of running over time a little, so let's pick up on one final question. Maybe somebody who's not asked a question at the moment. Nick. Oh, sorry, Tim. Tim has a question. Tim's raised his hand. You'll have to unmute Tim. Right. Okay. Tim, we can't hear you. Okay.
Is that better? I'm put.
Yeah.
It's interesting, Bill, that you're into alternative assets and tangible assets, capital assets like aircraft. And unfortunately, those assets obviously have crashed as a result of COVID. Do you think, though, that what I've seen in capital assets, values have actually increased in the last 12 months. So if you look at Ritchie Brothers Price, who sell yellow metal from Canada, the biggest listed auctioneer, their stock price has increased hugely since COVID. If you look at capital assets that we sell, so engineering stuff, all that kind of stuff, the prices have never been better.
Yep.
Which is an odd response. I'd be interested in your response to that in terms of where that's happened in the last 12 months when everything else has been going south.
Yeah, okay, well, I think, there's been a general increase in any asset as a stock. That's one of the features of financial asset inflation. There has been a general move in any gold producer or part of the gold supply chain that has greatly exceeded the gains we've seen in the yellow metal itself. There is also, I think, another thing going on that in the real world where people understand that you need real assets to produce real assets, the value of all these things is going up because we've realized that we actually need them. And I was talking earlier about this ESG conundrum that you cannot invest in, metallurgical coal, despite the fact you can't make steel without it. Whatever people say about using hydrogen, you need metallurgical coal. The result of that is you do have general scarcity. Assets made out of engineering assets go up in value as a result. But there's also, I think, a fundamental shift going on. It's a bit of a backlash against the ESG thing, and I've seen that very clearly. One of my favorite stocks just now is a company with a very long history. They consistently profitable. They trade in something like 12 times price earnings ratio. They've just been awarded a global sustainability award from the World Bank because of the quality of the work they're doing with their suppliers. And it produces a consistent 6 to 8% dividend yield every year. But the stock is not going to go up mildly in price. It's a dividend stock. And about half of the world's institutional funds will not touch it. Can anyone guess what the stock is? It's BAT, British American Tobacco. And the reason it's got such a sustainability high rating is because they pay fair prices to farmers. They're working with farmers to improve their yields. And they're also investing a fortune in creating safe tobacco because they understand that the third world still wants to smoke. I don't smoke and I'm not going to, but I also see it as a bit of a reaction against the extremists on the ESG side. And that's what people want to buy, let them buy. This is the society we would like to live in. And the result of that is that people are looking in other areas like real assets to say that it's mad to say you cannot buy planes because they create pollution. It's mad to say you cannot buy a transformer because you can't use that transformer to power an electric vehicle unless you have it. So that's, I think, one of the reasons that real asset prices are beginning to rise in the world. I'm sorry if that's not the best answer you've ever got.
It's interesting, because it's also interesting that in June last year, classic car auctions went mad and the prices were absolutely ridiculous. So is there a sense that people also cluster towards those kind of assets because the prices were, all the dealers exited their stocks and everybody sold everything at double the price?
Okay. Yeah, that is very interesting. I've looked at classic cars a number of times. I don't have one. I'd love to, but I've got other things. When you own yachts, you can't afford cars.
Yeah.
But it is a fascinating market. But equally, so are other markets like that. The value of Scotch malt whiskey, which I'm an aficionado. Some of the bottles that I could have bought from the Scottish Malt Whisky Association 20 years ago are now trading in 5 digits. We just popped the cork off them and downed them in an evening. That's the way the world goes.
Those are the days.
Yeah.
Those were days. Okay, look, thank Bill. I would really like to thank you for an hour and a half today of your time, and I think for all of us on the call, it's been a fascinating overview. So let's have a virtual round of applause for Bill. Well done, Bill. Thank you very much.
It's been an absolute pleasure. Thank you all very much indeed. And I look forward to being able to meet you all face to face when we eventually can.
Well, we're rather hopeful we'll have our Christmas event, and obviously you were a guest last year to that, so the invitation is still there, so you'll be very welcome.
Excellent.
I'd just like to.
I will be down in Salcombe, I think, at some point during the summer.
Oh, I'll see you down there during the summer. I would just like to thank everybody for joining us today. Just to remind you that our next call is drinks. And Bill, you're welcome to join us next Thursday for drinks on the 15th, where we have a virtual drinks session. And then, of course, on the 28th and 29th of April, we've got our virtual global conference, Transact 360, and many of you will have been bothered, particularly by Matthew and I, over the last few days, encouraging you to register for that event. It's only $149 with some top class speakers, as you know, such as former US Secretary of State Colin Powell. So I do encourage you to register for that. A number of us are running roundtables on that during that event, and it should be very interesting. So with that, I would like to thank you all. All have a really, really good evening. Bill, enjoy yourself and have a wee dram for us up in Edinburgh.
Thank you very much.
So good night to you all.
Bye bye.
Good night.
Good night. Thank you, everyone. Thanks.
Bye-bye.
Bye-bye.